So imagine for a second that a massive natural disaster hits, right? Like a catastrophic hurricane.
Yeah.
And an insurance company just completely runs out of money to cover all the destroyed homes. How do they keep writing policies? I mean, they don't just declare bankruptcy and walk away.
Right. No, they definitely don't.
Yeah, instead they quietly attach this financial thing, a sidecar, which is actually funded by, your pension plan just to keep the whole engine running.
It really is this hidden, kind of misunderstood reality of global finance. Because when a catastrophic event wipes out a huge chunk of an insurer's capital, the demand for insurance doesn't just disappear.
It goes up, right?
Exactly, it skyrockets. People and businesses are absolutely desperate for coverage exactly when the insurance company's coffers are, well, at their absolute lowest.
And usually, if a regular business needs a massive influx of cash to handle a spike in demand, they have standard levers they can pull. But as we explore the sources for today's deep dive, we see that traditional financial mechanisms, they're just too slow, or too permanent, or too cumbersome to fix this immediate, immense gap in catastrophe funding.
Which is exactly why the industry developed sidecar insurance. And I'll say, whether you're a CPCU student mastering the nuances of risk transfer, or an insurance professional looking to understand alternative capital, or, just someone listening right now who is curious about how global financial risks are actually managed, this concept is just a brilliant window into the invisible gears of the economy.
It really is.
Yeah.
And to understand how they actually pull this off without blowing up their own business, think about a booming pizza shop.
Okay, a pizza shop.
Yes, stick with me here. So the lines are out the door, the reviews are incredible, and you desperately need more ovens to meet the demand. But you do not want to take out a massive 30-year commercial mortgage just to handle what might be a temporary summer rush,
Right, because taking on permanent long-term debt or even selling off shares of your shop to solve a temporary capacity issue, it's a terrible long-term financial strategy.
FOMO.
You're permanently altering the structure of your business for a seasonal spike.
Exactly. So instead, a group of outside investors comes in and says, hey, we will buy those extra ovens for you. They
Right.
provide the raw capital. And in return, they get a specific share of the profits from the extra pizzas that those exact ovens produce.
Right, a very specific share.
Yeah, and here is where it maps perfectly to insurance risk. If a grease fire burns down the kitchen and destroys those ovens, the investors take the hit alongside you. They share in the catastrophe.
That's a great way to look at it, because in the insurance industry, those extra ovens are basically what we call a sidecar.
Wow.
Technically, it's a special purpose vehicle or an SPV. So it's a completely separate legal entity that's created specifically to let outside investors provide capital to an insurance or reinsurance company, but for a very defined portfolio of risks.
I just have to say, Sidecar is such a quirky, vivid name for a highly sophisticated financial instrument. Like, who came up with that?
I know, right? But the visual is actually highly descriptive of the legal and operational structure. So imagine the main insurance or reinsurance company as a motorcycle driving down the highway.
Okay.
That motorcycle has the engine, the handlebars, the driver. The primary company is the one underwriting the policies, dealing with brokers, processing everyday claims, and essentially steering the overall corporate journey.
So they have full control of the operations and the overall strategy.
Exactly. And then you physically attach a sidecar to that motorcycle. The outside investors are sitting in the sidecar. They're attached to the company. They're going on the exact same journey, and they're exposed to the exact same bumps in the road, the risks.
But they don't have their hands on the handlebars.
Precisely. They aren't steering the ship. They don't hire the underwriting staff or decide what new markets to expand into. They're just along for the ride to share a very defined portion of the risks and the profits.
That makes so much sense. It's just a parallel, attached entity that doesn't interfere with the main operations of the primary business. But hold on, why go through this complex SPV setup at all? I mean, if a normal Fortune 500 company needs cash to expand capacity, they just issue more stock.
Right.
Why can't a major reinsurer just go to the open market, raise permanent equity, and use that money to write more hurricane policies?
Because issuing permanent equity permanently dilutes the ownership of the existing shareholders. You're essentially giving away a piece of your company forever to solve what is, at its core, a temporary weather problem.
Oh, wow. Okay, so if a massive storm hits and suddenly everyone wants hurricane insurance, that spike in demand might only last 2 or 3 years.
Exactly.
If they issue stock to cover that spike, they're giving away permanent ownership for a temporary market condition. That is terrible trade.
It is entirely inefficient, and this is exactly why sidecars are almost always born out of disasters.
All right.
I mean, if we look at the historical precedents in our sources, the modern sidecar market really exploded after Hurricane Katrina in 2005.
Oh, yeah. 2005 was brutal.
Right. Katrina, along with Rita and Wilma that same year, caused tens of billions of dollars in insured losses. The traditional reinsurance market was completely shell-shocked. Companies were facing credit downgrades, and their capital reserves were totally depleted overnight.
And you can't legally underwrite new policies if your balance sheet is completely wiped out. Like, regulators simply won't allow it.
They absolutely won't. So the very next morning, the market is begging for reinsurance coverage. And reinsurers want to provide it because pricing usually becomes very, very attractive after a major storm. But mathematically, they just lack the sufficient capital to safely write those new policies.
So the sidecar steps in.
Yes. A sidecar allows them to surgically inject alternative capital for a set period without diluting their own equity base.
Okay, let's look at the other side of this equation then. Because we're talking about hedge funds, private equity, massive pension funds pouring hundreds of millions of dollars into these sidecars. Why on earth would a conservative pension fund want to bet on hurricanes?
Well, it really comes down to one of the most sought-after concepts in finance, which is uncorrelated returns.
Uncorrelated returns.
Right. So if the stock market crashes because of a sudden banking crisis or, a tech bubble bursting, that economic downturn does not cause a hurricane to hit Miami.
Oh, I see.
The risk of natural disasters is completely detached from traditional economic indicators.
That is fascinating. So they're essentially diversifying their investment portfolio with Mother Nature.
Yeah.
Like, if Wall Street has a terrible year, the sidecar investment might still yield a massive return just as long as the weather is calm.
Yes, exactly. Investors are constantly hunting for yield that won't just tank because the broader financial markets have a bad quarter. Sidecars offer highly attractive potential returns, assuming, of course, that the catastrophic risks don't actually materialize during the life of the investment.
Right, assuming the wind doesn't blow too hard.
Exactly.
Okay, let's trace the actual dollars here. Because it's one thing to say investors put in money, and it's another to understand how the plumbing actually works to protect everyone involved.
Sure.
Say a pension fund decides to put, I don't know, $500 million into one of these sidecars. What actually happens to that cash?
Well, that $500 million doesn't just get handed over to the reinsurance company's CEO to use as working capital.
Right.
It gets deposited directly into a highly regulated trust account.
So it's locked up. It's serving purely as collateral then.
Fully collateralized, and this is a critical mechanism. Regulators demand absolute proof that the money is sitting there, usually in cash or highly liquid, extremely safe securities like short-term government bonds.
Because if a disaster strikes, they need to know the money is actually real.
Exactly. That money must be available immediately to pay claims. It protects the integrity of the entire global insurance chain.
And I noticed in the sources they mentioned that sidecars are often established in very specific jurisdictions, like Bermuda. Why Bermuda specifically? Is it just a tax haven thing?
It's actually much more about regulatory expertise and speed to market. Bermuda has spent decades developing a highly specialized, very sophisticated regulatory framework designed specifically for these types of SPVs.
Oh, so they just know how to handle them.
Yeah, when a disaster like Katrina happens, capital needs to be deployed in weeks, not years. Bermudian regulators understand the mechanics of collateralized reinsurance intimately, so they can approve and monitor these structures with incredible efficiency while still ensuring that the $500 million is irrevocably committed.
Wow. Okay, so the sidecar is sitting there with $500 million locked in a trust in Bermuda. How does it legally connect to the main company's actual insurance policies?
That happens through a specialized reinsurance agreement, which is typically structured as a quota share arrangement.
Wait, quota share meaning they take a strict, predefined percentage of every single policy in that specific portfolio.
That is the perfect way to summarize it. Let's run a quick scenario just to be clear.
Okay, let's do it.
Say the sidecar agrees to a 20% quota share on a portfolio of Florida hurricane risk.
Got it, 20%.
If that specific portfolio generates $100 million in premiums from homeowners over the year, the main company collects all of it initially, but then passes $20 million directly into the sidecar.
Okay, so the investors just made a $20 million return on their locked-up capital.
Nice. But if a hurricane hits and that portfolio suffers $50 million in total claims, the trust account is drawn down to pay $10 million.
Because that's exactly 20% of the losses.
Exactly. The main company pays the remaining $40 million. They share the fortunes of that specific slice of business completely symmetrically.
Wow.
If it's a quiet season, the investors make a fantastic return. If a storm hits, they absorb the hit, which powerfully protects the primary insurer's balance sheet.
When you step back and look at the macro level here, the influx of this alternative capital fundamentally alters the entire insurance ecosystem. I mean, we're talking about billions of dollars flowing from global capital markets directly into catastrophe risk.
It creates massive ripple effects. Because sidecars inject so much capital into the system, they drastically increase the global market's overall underwriting capacity.
And for anyone new to this, underwriting capacity is basically the total maximum amount of liability that all the insurers combined can safely assume based on the capital they actually hold.
Correct. And basic economics dictates that when you increase the supply of something, in this case, the supply of capital available to back up risk the price usually responds.
The price comes down, or at least I guess it stabilizes.
Yes. When more capital enters the market through sidecars, reinsurers can actually offer more competitive rates. If this alternative capital didn't exist and reinsurers only had their own balance sheets to rely on, traditional reinsurance would be incredibly expensive.
Which means retail insurers would have to drastically raise premiums for everyday homeowners.
Exactly.
Or worse, just stop offering coverage entirely in high-risk places like Florida or California. And that makes this deeply relevant to you, the listener, even if you never work in finance.
Oh, absolutely.
Because the pension funds managing your retirement might be acting as the ultimate shock absorbers for natural disasters. They literally take the financial hit so the insurance company doesn't go bankrupt and can actually pay to rebuild the destroyed homes.
It is a massive structural transfer of catastrophe exposure, but, because the mechanism is so elegant yet so specific, it is notorious for being misunderstood within the industry itself.
Oh, I bet. And for anyone listening who's navigating the CPCU curriculum right now, whether you're diving into commercial property risk in 551 or commercial liability in 552, or even the finance and accounting modules like 542, the nuances of how these vehicles operate are just critical.
Very critical. Yeah.
You really have to know how to cleanly separate a sidecar from other risk transfer tools.
Yeah. There are several massive industry misunderstandings that consistently trip people up, both in real-world boardrooms and on those exams.
So what's the first one?
The biggest one is confusing a sidecar with an actual insurance company.
People hear the term special purpose vehicle and they assume it's a brand new insurance startup.
Exactly, but it's not. Remember the motorcycle analogy. A sidecar does not operate the business. It doesn't have an army of underwriters analyzing individual homes. It doesn't deal with direct retail clients, and it doesn't issue its own primary policies.
It simply assumes a predefined block of risk from the main company.
Right.
It's just the extra ovens, not a whole new pizza brand.
Exactly, well put.
What's the next big point of confusion?
Conflating sidecars with captive insurance.
Captives.
Yeah, a captive is typically created by a non-insurance parent company. Think of a massive multinational manufacturing firm to self-insure its own internal corporate risks.
Okay, so a captive is internally focused, but a sidecar is funded by independent outside investors to assume third-party risks. The strategic purposes are completely opposed.
Exactly right. But the misunderstanding I see the most, the one that really tangles people up, is the difference between a sidecar and a catastrophe bond, a cat bond.
I can see why, honestly. Because both involve outside investors, both deal with catastrophic weather events, and both are forms of insurance-linked securities. So how do we cleanly separate the two for the exam?
It all comes down to the mechanics of how the risk actually transfers. In a sidecar, you are essentially setting up a temporary mini reinsurance company.
Right.
You share in the ongoing premiums and the ongoing losses of a whole slice of business through that quota share agreement we discussed. You're riding in the sidecar for the entire duration of the contract, sharing the fortunes of the portfolio.
But with a cat bond, you aren't sharing an ongoing portfolio of individual policies.
No, you're just buying a financial security with a binary trigger. If a hurricane hits Miami and causes a predefined specific dollar amount of industry-wide loss, the bond is triggered and you lose your principal.
Wow.
You don't own a vehicle executing reinsurance agreements. You just made a highly structured financial bet on a specific catastrophic event.
That is a crucial structural distinction. So sidecar investors essentially own a slice of a reinsurance operation. But cat bond investors just bought a bond with a trapdoor.
Exactly.
So to distill all of this down, the sources offer this fundamental equation, a memory formula that clarifies the entire concept. And it basically comes down to three pillars. outside capital plus reinsurance equals shared catastrophe risk.
If you hold on to those three elements, you understand the architecture of this entire market. The capital comes from the outside, the legal mechanism is a reinsurance treaty, and the ultimate purpose is sharing extreme catastrophic exposure.
And the overarching why behind all of it, the definitive reason a reinsurer establishes a sidecar instead of anything else, is to obtain additional underwriting capital without issuing permanent equity.
That is the absolute core of it. They secure a vital lifeline of capacity, completely avoiding the permanent dilution of their own ownership. It's really a temporary, surgical, and brilliant solution to the immense volatility of natural disasters.
We have covered a massive amount of ground today. I mean, from a booming pizza shop needing extra ovens to billion-dollar trust accounts locked up in Bermuda, we've really seen how sidecars act as an attached parallel vehicle to an insurance company's motorcycle.
Yeah, they allow global capital markets to step in and fund vital underwriting capacity when the world needs it most.
And they do it while bringing stability to reinsurance pricing, which, as we talked about, ultimately impacts the premiums everyday people pay to protect their homes and businesses.
It really is a fascinating hidden system.
But before we wrap up this deep dive, I want you to consider the changing baseline of the world we live in. We've talked about sidecars as an alternative tool, right? Like a temporary surgical fix to bridge a gap after a particularly bad storm season.
Yes, traditionally they're viewed as a stopgap measure.
But as natural disasters become more unpredictable, more severe, and vastly more frequent, traditional pools of insurance capital are constantly under threat. The baseline of what is considered normal risk is fundamentally changing.
It really is.
So could structures like sidecars eventually transition from being just a handy alternative tool for emergencies to becoming the primary engine that keeps the entire global insurance industry afloat.
It raises a profound question. If the frequency of these catastrophic events continues to accelerate, are we rapidly moving toward a future where global capital markets, the massive pension funds and sovereign wealth funds, are actually the only entities on Earth large enough to backstop our climate risks?
It's definitely something to think about the next time you hear about a major storm making landfall. The physical damage you see on the news is really only one part of the story. The invisible financial machinery working furiously behind the scenes to rebuild it is just as complex and, honestly, just as critical.
Very true.
Well, thank you for joining us on this deep dive. Keep exploring, keep questioning the hidden systems that run our world, and we will see you next time.